What if you could wake up every single month and find cash deposited into your account? Money you did not have to work for, money that just showed up because your investments were doing their job? That is the dream of passive income, and it is not as hard to achieve as you might think. Today, I am going to show you several Fidelity funds that are designed specifically to pay you passive income every month. Some of these are mutual funds. Some are ETFs. Some focus on high dividends. Some focus on bonds. And each one offers a different way to generate a reliable stream of cash that you can use to pay bills, reinvest, or simply watch your wealth grow. But before I get into the specific funds, let me clear up something important. When I say monthly income, I am talking about funds that make distributions to shareholders on a monthly schedule. Most mutual funds and ETFs pay dividends quarterly, meaning 4 times a year. These funds pay 12 times a year. That monthly cadence can be incredibly helpful if you are using this income to cover regular living expenses in retirement or just to build a habit of consistent cash flow. Now let me make this clear. Not all monthly paying funds are created equal. Some focus on high current income, which means higher yields but potentially less growth. Some focus on a mix of income and capital appreciation, which means lower yields but better long-term total returns. I am going to show you examples of both so you can decide what fits your situation. Let us start with the core monthly income fund. That is the Fidelity Monthly Income Fund. This fund is designed to do exactly what its name says: provide monthly income. It holds a neutral mix of approximately 55% equities and 45% fixed income securities, which gives you a balance of growth potential and stability. The fund has been around for decades, with an inception date of November 2003, and it has a trailing 12-month yield of roughly 0.95%. Its management expense ratio, or MER, is 2.07%. I want to be honest with you, a 0.95% yield is not going to make you rich overnight. But remember that this fund is not just about yield, it is about total return. Over the past 10 years, this fund has delivered an annualized return of approximately 5.66%, and since inception, it has returned about 6.83% annualized. That combination of modest income plus capital appreciation is what makes this fund work for long-term investors. Now, if you are serious about monthly income, you might want to look at the Fidelity Monthly Income Class Series FUST version. This share class has a weighted average dividend yield of 2.41% at a net expense ratio of 0.92%. That is a much higher yield than the standard version, but it is typically only available to fee-based accounts or investors who work with a financial advisor. Still, it is worth knowing that Fidelity offers different share classes with very different yield profiles. Now let me show you something completely different. If you are willing to accept quarterly dividends instead of monthly, but you want much higher yields and exposure to some of the best companies in the world, you need to look at the Fidelity High Dividend ETF. This ETF has quietly become one of the top-performing dividend funds in the market. It has delivered a trailing 12-month distribution yield of about 3.1%, with an expense ratio of just 0.16%. That means for every $1,000 you invest, you pay just $1.60 per year in fees. What makes this ETF special is that it is not your grandfather and #39's dividend fund. Most dividend ETFs focus on boring, slow-growing companies like utilities and consumer staples, but FDVV holds companies like Nvidia, Apple, and Microsoft. In fact, its top holdings are Nvidia at over 6% of the portfolio, Apple at nearly 6%, and Microsoft at over 4%. The fund holds about 113 stocks in total, with heavy weightings in technology and financials. This mix of high-tech growth and dividend income has produced outstanding results. Year 2. Date in 2025, FDVV returned nearly 15%. Over the past year, it returned about 12%, and over the past 3 years, about 17.6% annualized. And those numbers do not even include the dividends you would have reinvested. The fund has a 30-day SEC yield of 2.82% and a trailing 12-month distribution yield of 2.83%. Now, there is a catch, and you need to know it. FDVV pays dividends quarterly, not monthly. So, if you absolutely need cash every single month, this might not be your perfect fit. But if you are willing to manage your cash flow a little bit, the combination of high yield and strong growth makes FDVV a compelling option for passive income investors. If you want monthly dividends and international diversification, Fidelity has something for you. 2. The Fidelity International High Dividend ETF, ticker FCID, focuses specifically on dividend-paying companies in international developed markets. Its trailing 12-month yield is an impressive 3.99%, and its management expense ratio is just 0.50%. Over the past year, this F returned nearly 30%. Its top holdings include European and global companies like Enel, National Grid, Shell, and SBC. The fund holds over 30% in financials and about 13% in materials, which gives you a very different sector exposure than a U.S.-focused fund. This is a great way to add geographic diversification to your income portfolio while still collecting monthly payouts. Now let me shift gears and talk about bonds, because not everyone wants the volatility of stocks in their income portfolio. If you are retired or close to retirement, you might prefer something more stable. Fidelity offers several monthly paying bond funds that could be a great fit. One example is the Fidelity Limited Term Bond Fund, ticker FJRLX. This fund invests in investment-grade bonds with relatively short maturities, which means lower interest rate risk than long-term bonds. It pays a monthly dividend of approximately 4 cents per share, which works out to an annual yield of around 4.04%. The dividend has been consistently paid every month, and the fund provides a much smoother ride than stock-based income funds. Now I want to give you a practical way to think about all of these options. You have 3 different tools for building monthly passive income. First, you have balanced funds like the Fidelity Monthly Income Fund. These give you a mix of stocks and bonds, moderate yields, and consistent monthly payouts. They are great for conservative investors who want stability first and income second. Second, you have equity-focused monthly income funds like the Fidelity Global Monthly High Income ETF, ticker FCG. This ETF allocates about 64% to equities and 35% to fixed income, giving it a yield of roughly 3.6 to 4%. Its weighted average dividend yield of 4.05% outperforms many bond alternatives, while its equity exposure provides upside in rising market. The fund is designed to generate monthly income and preserve capital through a globally diversified portfolio. Third, you have high-yield ETFs like FDVV and FCID. These have higher yields typically, between 3 and 4%, but they only pay quarterly, and they come with higher stock market volatility. These are best for investors who are still in the accumulation phase and want to grow their capital while collecting some income along the way. So how do you actually build a passive income portfolio with these funds? Let me give you a simple framework. If you are a retiree or close to retirement, consider putting the bulk of your income portfolio into Balanced monthly income funds and bond funds. For example, put 60% into the Fidelity monthly income fund or a similar balanced fund and 40% into a limited-term bond fund, like FJRLX. This gives you stability, monthly cash flow, and very low risk. If you are a mid-career investor who wants to start building passive income but still needs growth, consider a hybrid approach. Put 50% into a growth and income ETF like FDVV, 30% into an international income fund like FSID, and 20% into a bond fund for stability. This gives you higher yields, global diversification, and still plenty of growth potential. And here is the most important thing. Reinvest your dividends if you do not need the cash right now. Set up automatic dividend reinvestment. That monthly income buys you more shares, which then pay you more income next month. That is how you build a snowball. Over time, that snowball grows into something truly life-changing. A few final things to keep in mind. Monthly income funds are often best held in tax-advantaged accounts like IRAs and Roth IRAs. Because these funds distribute income regularly, you might owe taxes on those distributions each year. In a retirement account, those taxes are deferred or eliminated entirely. Also, remember that higher yields often come with higher risks. A fund yielding 4% might be taking on more credit risk or interest rate risk than a fund yielding 2%. Always read the prospectus and understand what you are buying. The most important step is to start. Open an account, pick one fund that makes sense for your situation, and set up automatic contributions. Then watch as that monthly income starts to show up in your account, month after month, whether you are working or not. That is financial freedom. Thank you for watching. If this video helped you think about passive income differently, hit the like button and subscribe. We have 2 more videos in this series coming up, covering the best Fidelity funds for beginners and the top low-cost Fidelity funds smart investors use. You do not want to miss those. See you in the next one.